Hey everybody, this is Dale Anderson from Fabrik Invest. I hope you're keeping well. So we just received the latest housing report by Zoopla. Zoopla is one of the largest real estate online listing companies in the UK. They monitor the data and market research across the whole of the UK market. Just wanted to touch on a few points today regarding the latest forecast. So what they're saying is they're still seeing a price increase of plus 7.8%, but there is now a 28% drop in sales volume versus a year ago. And homes with any size of asking price reduction since the 1st of September is up by 25%. So to summarize, since the mini budgets, fallout, Liz Trust's budget, the fallout hit demand by minus 44%, more than new sales at minus 28%. New sales fell by half in the hottest markets, less in affordable areas. Lower sales and new supply are boosting sales inventory. However, ongoing scarcity expected to remain in 2023, limiting the downside for prices. House price inflation is losing momentum at a speed, but no price falls have actually been recorded over the last quarter in any region or major city. Discounts to asking prices on new sales have widened in recent weeks. And there's also a diverse range of need-driven factors expected to support sales volumes, with mortgage rates set to start 2023 at 5% level. So I'm just going to share screens. We can share some of the data with you and then go through the rest of the report. So as you can see by this chart, demand has declines more than sales as supply recovers. We do see a minus 47% demand recently. Minus 28% number of sales agreed, and 10%, in terms of the flow of new supply, as well as 40% stock of homes for sale. So we still expect house price falls of up to 5% in 2023, according to Richard Donnell of Zoopla, with 1 million sales and mortgage rates dipping below 5%. But the number of sales going through will remain buoyant for a range of structural, demographic, and economic factors. So a few things to consider. Since the mini budget fallout stalls market activity in Q4, the spike in mortgage rates after the mini budget have certainly not helped. The demand has fallen to levels normally associated with the Christmas period, and new buyers sit on the sidelines, watching the outlook for mortgage rates and what the economic headwind means for jobs and income. So I think a lot of people are just a little bit nervous about the uncertainty in the markets. New buyer demand is almost half the level a year ago, when market conditions were much stronger and mortgage rates lower, and there were fewer cost of living pressures on households and budgets. Sales volume decline less than buyer demand. They're seeing new sales are still being agreed by those with mortgage offers and the motivation to move. For example, would-be first-time buyers facing steep rent rises, and older households less reliant on mortgage finance to fund a move. So sales volumes are down, as you can see, 28% from a year ago, on par with pre-pandemic levels. We are transitioning from an unsustainably strong market to a more balanced one. It's a bit of a price correction, albeit with demand side headwinds for households most sensitive to higher mortgage rates. Sales volumes are down by almost half in areas where market conditions have been hit the hardest, in particular the mid to upper price band in southern England, excluding London, which is fairly resilient, the East Midlands and Wales. The decline in sales volume has been smaller in more affordable markets, for example, Scotland and the Northeast, as well as the Northwest. Sales in London are also holding up better than the national average, but the capital's housing market has been far more subdued, lagging behind the rest of the UK. So if we look at this chart, this shows you buyer demand down 44% since the mini budgets. And you can see the chart at 2020 compared to 2021, and then 2022, which is the darker line here, as you can see, since that mini budget has happened, what's happened to the demand. Sales inventory recovering off a low base, weaker sales and more homes coming to the market does mean there will be more stock of homes for sale, and sellers will need to think about their prices if they are asking for over market value or high prices, because there was such strong demand before. This is the highest since January 2021, but almost a fifth lower than pre-pandemic levels. The trend is being recorded across all areas of the UK. So rebuilding sales inventory, which boosts buyers' choice, is part of the move to a more balanced market. It's important that these homes are priced in line with what buyers are prepared to pay, given the hit to buying power. So we analyzed the repricing process underway late in the report, However, for now, more homes for sale will reduce the scale of the upward pressure on house prices. Our expectation is that we won't get an oversupply of homes in 2023, according to Zoopla. We expect some elements of scarcity to remain a feature of the market, limiting the downside for pricing levels. So if you see the chart here, available homes for sale recovering as activity slows, total supply remains 19% below the 2017 to 2019 average in terms of supply in the housing markets. The fallout from the mini budget has clearly delivered a shock to sellers and buyers. New sales have been more resilient than some may have expected. Committed buyers and sellers continue to bring homes to the market and agree on deals. Obviously, the fall through rates are higher, but not unmanageable for agents. The data shows that 1 in 15 homes formerly sold is returning to the market after the original sale has fallen through. So a lot of my estate agent friends have said that they have had fall throughs of clients expecting lower borrowing rates and then withdrawing their offers when the rates went up. All the leading supply and demand indicators we measure continue to point to a rapid slowdown from a very strong market. We do not see any evidence of forced sales or the need for a large double-digit reset in the UK house prices in 2023. So unlike what a lot of the media is saying, it can be quite negative. They do believe it is a bit of, I guess, price correction after what's been a very buoyant or strong period. So a bit of balance in the market. House price inflation is responding to weaker demand, of course. UK house price inflation has slowed to one of its lowest quarterly rates of 0.7%. At this stage, none of the major city or regional level are recording price falls over the last 3 months. What is clear, there is a major loss of momentum in the rate of quarterly price inflation across all areas, including major cities. UK house price growth is heading to 0% during 2023. So if we check the chart, house price growth slows down across UK cities. We've got Nottingham, Birmingham, Manchester, Sheffield. So you can see in the previous 4 quarters, there was quite strong growth of around 2-3%. So the market was heated. October 2022, it slowed down. Finally, widespread repricing of sales inventory is underway. There's already a widespread repricing of homes for sale, which might be seen as relatively modest reductions at this stage. The core measure we track is asking price reductions of around 5% or more. The measure has jumped over the autumn, but importantly still remains below 2018 levels. Taking a broader view, 1 in 4 homes for sale since 1st September has experienced a price reduction. Price reductions have been greatest in south of England, where sales activity has fallen. South and east of England regions have seen almost 1 in 3 homes for sale have their asking price reduced in the hope of attracting more buyer interest. As you can see in this chart, there has been widespread repricing underway. And again, we look at different cities and we look at the different categories there in terms of how much the asking prices may be asked to be reduced if they have been priced market value or over market value. So sellers are less likely to achieve asking prices. Over the last few weeks, we have seen clear evidence that buyers are starting to get bigger discounts from sellers as sales are agreed. Data from Zoopla's valuation and property risk business Home Track shows that the gap between the first asking price and the agreed price has started to widen in recent weeks. Strength of the post-pandemic market results in buyers having to pay on average 100% of the asking price or higher in some occasions for much of 2021 and 2022. The average discount to achieve a sale has widened to 3% in recent weeks. So we expect the discount to widen further as we move to more of a buyer's market. The positive is that strong house price growth has given sellers more room to negotiate an asking price. The prospects for 2023 really depend how willing sellers are to adjust asking prices in line with what buyers are prepared to pay. So there may be some good potential opportunities coming our way in 2023 for people looking to get a good deal. The proportion of asking price achieved does take a dip. So you can see again in this chart, the percentage of asking prices achieved versus a 4 weeks rolling average, initial asking price versus the achieved price in November 2022. High levels of rental inflation are a factor, adding to the cost of living pressures for renters. So affordability will of course become a factor as well. The drivers and motivators are, of course, the result of the pandemic, the greater labour market flexibility, and the rise in retirement. A return towards 4-5% mortgages rates in 2023. So after the budget, mortgages were exceeding 6%. However, the outlook for 2023 is we're already seeing interest rates fall back down to 5%, which is good news. Historically, I mean, these have been normal rates. We've just been in a period for the last couple of years of really, really cheap lending. So I believe people will just need to get comfortable with the fact, that we'll be looking at 4 or 5% interest, and just need to factor that in. So I think that's very important, that you do the maths and make sure that your rent is still covering your mortgage. This means that 5-year fixed mortgage rates are likely to start in 2023. So what is the outlook? Looking ahead, and expectations for 2023 remain the same as reported in their last reports. House price falls of up to 5%, concentrated in the higher value markets. This is the house price index. And as you can actually see, prices, the annual change is still up 10.5%. Nottingham, 9.3%. Manchester, Birmingham at 8.9%. Liverpool, 8.7%. Sheffield, 8.5%. So any investors who did buy with us in some of these cities over a year ago or 2 years have actually done quite well on the growth. So if prices fall at 3, 4, 5%, they're actually still in a plus 2 or 3% category. So property is to be viewed as a mid to long-term strategy for capital growth. And I think the main thing with regards to buy-to-let is to look at your rental income versus your expenses and your mortgage costs. You can still make some really good investment decisions in cities like Liverpool, Birmingham, Manchester, which have been booming, and there's still a lot of investment and regeneration going on in those areas. So onto the next slide, we can see here that this is the house price index city summary, and again it shows you the average prices in Manchester 219,000, Liverpool 155,000, Sheffield 171,000. All these areas we focus on where there is still good scope and there has been good growth over the past couple of years. So that's it from me, and we'll keep you updated on the latest news. I hope this has been useful, and please subscribe to our channel. Thank you very much. Take care.